Welcome to Running a Small Business, the New Rules, Part 2, Targeted Shareholder Employee Benefit Plans, Options, and Opportunities. The federal proposals released in July of 2017 were the most dramatic changes to the Income Tax Act affecting Canadian-controlled private corporations in 45 years. They triggered thousands of written responses from across the country and across dozens of organizations representing the interests of small business. This session picks up from another session update on federal proposals and legislation impacting small business, specifically Canadian-controlled corporations. Running a Small Business, Part 1. Today's session, Part 2, will take a deeper look at targeted shareholder employee benefit plans, options to hold retained earnings, ultimately destined, at least in part, to provide retirement cash flow, and trusts that provide benefits for select employees. Attendees will gain a clearer understanding of the ramifications of the proposals and options that they can discuss with small business shareholders. As always, this presentation reflects the view of Empire Life as of the date presented. This material is presented for informational purposes only and is not a legal, tax, or investment opinion. The provision of the information contained herein and any oral or written communication regarding the same should not, nor is intended to be construed as such, and interested parties should retain independent professional advice before acting or foregoing action in relation to any of the materials that I cover off today. There have been a lot of press releases, newspaper articles, debate, and changes since the original proposals were released quietly in mid-July 2017. It's created confusion and even more complexity than the proposals already contained. I'm going to pick up from my last session on both proposals and legislation impacting small business, specifically Canadian-controlled corporations. Today's session will take another look at targeted shareholder employee benefit plans. So I'll be providing you with an overview and update of the proposals, with alternatives for passive income, retirement income focus, and employee benefit plans, specifically the end of health and welfare trusts, alternative employee life and health trusts, and individual pension plans. The proposals will affect almost all business owners, now and in the future, and not just those in top marginal tax brackets. The changes will impact many well-accepted tax and estate planning strategies that are not tax loopholes. And there can be putative tax multiplier effects as each tax change can apply over a business owner's lifetime, including situations beyond the owner's control, such as illness and death. This whole concept of reasonableness and what that actually means is causing a bit of an issue with tax practitioners and planners as well as business owners. Some proposals will impact, as I said, plans already in place, resulting in significant professional costs to review and comply. And today's session should give you the opportunity and some of the ammunition to do some reviews with your business clients. The Canada Revenue Agency is being provided with some broad discussion in application of the rules. Terms like arm's length, reasonableness, or one of the main purposes. When we talk about reasonableness, we're talking about the contribution of labor, capital, the risk assumed, or total remuneration paid to an individual connected to that corporation and getting remuneration from that corporation. There are concerns that the details on reasonableness will be prescriptive. Could it be a checklist? Is it yes or no? What happens if it's not on the list? And the question that I've been asked in the past is, could this lead to increased litigation? According to a number of lawyers and the current and former Chief Justice of the Tax Court of Canada, expect increased litigation here. There appears to be too much vagary and too much subjectiveness in the assessment process of what constitutes reasonableness. And if people own shares, they have a legal right to a dividend. The proposed tax policy appears to ignore that, preferring to apply punitive income taxes and perhaps even deny refundable dividend tax on hand. If we look at reasonableness and then take that to the next step, to business succession, we're faced with some of the following issues and scenarios. What happens in a business succession if parents are selling to their children? Well, if the shares are subject to the tax and split income rules, then the full capital gain may be taxed as a non-eligible dividend. And if the multiplication of lifetime capital gains exemption is gone, is it also going to be retroactive? Well, after significant backlash from the business owners and considerable lobbying, the government appears to have stepped back at this time and is not moving forward with proposals to limit access to the lifetime capital gains exemption. And that's good news. Let's consider corporate life insurance. When you consider corporate life insurance and those types of situations, Section 148 of the Income Tax Act of Canada has some basic rules and associated regulations on life insurance that should not change based on the proposals and regulations that you're seeing going into force at this point in time and are about to go into force. So when you're looking at the impact of the proposals on things like the tax-free death benefit, exempt accumulation, and dispositions, there really should not be an impact there. The Conference for Advanced Life Underwriting has sought a specific exemption for life insurance given the 5 years of negotiations which culminated in revised rules affecting corporately owned life insurance and credits to the capital dividend account, which took effect in January of 2017. And barring some aggressive investment-focused applications of life insurance that's owned by a corporation should not be subject to any more income tax rules and challenges by the Canada Revenue Agency. And I'll be covering all of this off in a follow-up webinar sometime in the coming weeks. Now, keep in mind that distributions of taxable dividends to family members that's funded by life insurance may be affected by proposed tax on split income rules, and distributions of life insurance proceeds from policy dispositions may be caught by passive investment rules. But the thing that you should be listening to is this whole issue of aggressive investment-focused applications and what could happen if the Canada Revenue Agency deems that there are some aggressive investment-focused applications deemed to circumvent or avoid some of the rules that are in place. Under the passive investment rules, a gain on disposition and the refundable tax can be denied, so the top tax is triggered on the cash surrender value of the policy, and the distribution could be taxed as an ineligible dividend. And once the adjusted cost basis, of course, disappears, the tax percentage could go up to 70%. Now, according to the Conference of Advanced Life Underwriters and others, the theory behind tax treatment of passive income could be applied to life insurance, which is, of course, a passive asset, via further restrictions to the capital dividend account. So actively promoting cash value life insurance as the answer to corporate passive investing and taking out big billboards and promoting ads and doing this in a very aggressive manner can catch the eye and attention of the Canada Revenue Agency and trigger some unintended and certainly some undesirable results and actions by the Canada Revenue Agency. The proposed rules already have an issue with cash value options. Also consider whether Section 246(1) of the Income Tax Act of Canada could be used to challenge some corporate life insurance structures. Now, distributions of death benefit may be eligible for credit to the capital dividend account, but the Canada Revenue Agency could reassess and treat distributions as taxable dividends with accompanying denial of the refundable dividend tax paid by corporations on the original monies earned by the corporation, where the after-tax is used to very, very punitive. So we really don't want to go down that road. We need to stay focused on the life insurance need as the driver for the strategy and be prepared to defend why the structure is set up that way in terms of ownership, life insured, beneficiary, payor, type of insurance used, and of course the strategy being deployed. So again, stay focused on the life insurance need. The fall 2017 economic statement, which was released on October 24th of 2017, included changes to the small business tax rate, which will be reduced and has been reduced to 10.5% effective January 1st, 2018, and will be reduced to 9% effective January 1st, 2019. The release by the Department of Finance stated that concurrent with these changes will be adjustments to the dividend gross-up and tax credit mechanism. Specifically, there will be an increase to the amount of tax payable on non-eligible dividends paid in 2018, with a further increase for dividends paid in 2019 and future years. A notice of Ways and Means motion to implement these changes was also released by the Department of Finance. Now, all of this is a different and perhaps additional way of making the declaration of dividends paid to shareholders of private corporations on earnings from passive investments in their companies less and less attractive. Non-eligible dividends are received from Canadian-controlled private corporations that pay income tax at the small business rate. They are grossed up and reported on the receiving individual shareholder's personal income tax return as part of total income. The individual then may claim a tax credit. He or she may also claim provincial dividend tax credits on this income. The Notice of Ways and Means motion published on October 24, 2017 served to reduce the federal gross-up and tax credit rate for non-eligible dividends, as I mentioned earlier. The adjustments in the gross-up and tax credit scheme for dividends paid by Canadian-controlled private corporations on income qualifying for the small business tax rate will increase the amount of income tax paid on this type of income, and this may offset any perceived advantage gained from the announced reductions in the small business tax rate. So let's look at this on this particular chart. In 2017, the gross-up was 17%. In 2018, of course, it dropped to 16%, and the gross-up is dropping to 15% in 2019. The dividend tax credit, which at the time of the proposal stood at 10.5%, dropped to 10.03% in 2018 and will drop again to 9.03% in 2019. And these income tax changes may be in addition to proposals affecting eligibility for refunds of the extra income tax levied against corporate passive investment income. Corporate investment income is taxed at the general or high rates instead of the small business tax rate. And this is aimed to discourage shareholders from using the corporations as tax shelters for investment income. Part of that extra income tax may be refunded when the corporation declares a dividend to the shareholder, but we're seeing changes here in legislation as well. Otherwise, the total amount of income tax paid could approach 70% or more, much higher than if the individual had simply received all the profits from the company and invested them personally. Again, the income tax proposals put forth by the Department of Finance drive the total income taxes owed to these much higher levels. First, by denying any refunds on extra taxes first collected against the corporation, and second, by adjusting the gross-up and tax credit scheme. We do believe that one of the likely results of these federal tax initiatives, whatever their form, will be to kindle an increased demand for plans within private corporations with tax sheltering features. One of those plans could be an individual pension plan, or IPP. Now, what's the motivation to establish an individual pension plan? Well, it's to increase retirement savings on a tax-friendly basis, to reduce the taxable income in the business through past service contributions, to retain key employees. Perhaps it's to strip excess cash from the company in preparation for a sale or wind-up of the company. It may form part of a living buyout, and it certainly can address the proposed federal tax rules impacting Canadian-controlled private corporations. What is an individual pension plan? It's a one-person registered defined benefit pension plan sponsored by an employer. The contribution amounts are actuarially determined. It really is a supersized registered retirement savings plan that requires special actuarial and administrative services for compliance purposes. The benefits: covered individuals can receive an annual pension at age 65 equal to 2% of their indexed T4 earnings, subject to the maximum pension limit. These are the type of benefits you typically see only in the public sector. And the benefits can be adjusted for inflation based on the Consumer Price Index. If we're looking at ideal candidates for an individual pension plan, we've got to look to an incorporated company that's paying T4 income as a benefit, as a payout in recognition of services. So you're paying that to an individual who is acting as an employee. There's an employer-employee relationship. In fact, there must be a bona fide employment relationship. Dividend income, or T5 income, is not pension eligible. Typically, a candidate is over the age of 40. The older, the better. Most individual pension plans are implemented between the ages of 50 and 60. And as of 2017, of course, this goes up every year. It's an indexed amount. You can maximize your T4 income and maximize the benefit going into an individual pension plan once you hit about $146,000 of income, T4 income. Your prime candidates would be a profitable business seeking additional retirement savings opportunities, incorporated professionals, business owners, and highly paid executives. What are some of the advantages of a registered retirement savings plan? Well, you can contribute higher amounts for people fitting the age and earnings profile. You can make significant past service contributions at implementation. These plans are creditor protected, and the interest on funds borrowed for contributions is tax deductible. Once more, when you compare an individual pension plan to a registered retirement savings plan, contributions to an individual pension plan can be made within 120 days after the corporate year end, which is quite different than the 60 calendar years after the year end for a registered retirement savings plan. Now let me give you an example. Someone aged 55 years of age with full past service back to January 1st of 1991 and maximum earnings could expect to accumulate more than 50% additional savings using an individual pension plan compared to a registered retirement savings plan at age 60, 65, or 71. Now, past service provided must satisfy the past service pension adjustment requirements, and for past service, a connected person, that is to say someone who owns more than 10% of a company, so a shareholder owning more than 10% of the shares, can only go back as far as 1991 for past service, but non-connected employees can go back as far as the date of hire. These plans can also be set up on a multi-generational basis, which can make them ideal for a family business. There would be no need to wind up the plan on retirement or on the death of the primary annuitant. Future generations can join an existing plan if they're employed by the sponsoring company. And the death benefit after the survivor of the first generation retires leaves assets in the individual pension plan to fund the children's pension benefits, the children, of course, that are taking over the family business. Now, overall, when we're looking at some of the strategies that are being deployed right now and have been deployed in the past, and you consider these tax proposals and tax regulations, will some strategies still be used? And one of the questions that comes up is, well, does it still make sense to incorporate? Well, the quick answer is, well, yes, it does. It's to protect against liabilities and avoid personal risk. And what about free strategies? Again, these strategies will still be used because they can offer protection of the value to date for the original shareholders, and if the owner is active post-freeze, everything should be okay. If a family trust is being used, keep in mind that you should put the active people in the trust. And a family trust, of course, can offer some protection in terms of both family law claims and creditors. Challenges, of course, always bring opportunities. When you look at life insurance in a corporate setting, life insurance owned by a corporation can deal with higher taxes at death. It can preserve the corporate asset value for beneficiaries. It can pay for the capital gains that are ineligible for lifetime exemptions. It can provide cash to fund the wind-up of a business, to fund the sale of a business, to replace funds used for survivor benefits that are now lost to taxes, and to support the insured retirement plan strategy. We also can look at insurance-based investments. Insurance-based investments, of course, are in the same boat as any other type of investment. So we need to promote the distinguishing features and benefits of these types of programs. And we could perhaps use surplus or profits to fund individual pension plans, retirement compensation arrangements, or other group benefits using these underlying investments as the vehicle for investment purposes. Let's move on right now to health and welfare trusts and what I call the beginning of the end. An employee life and health trust was a new trust that was announced on February 26, 2010. It was introduced to provide tax treatment of designated employee benefits the same way as if they had been paid directly by the employer for an inter vivos trust set up after 2009. Designated employee benefits include group sickness or accident benefits, a private health services plan benefits, group term life insurance benefits, and it applies both to employees and former employees. The second inclusion of the definition of an employee life and health trust under subsection 248(1) of the Income Tax Act, Canada, serves to exclude these trusts from the definitions of an employee benefit plan, a salary deferral arrangement, and a retirement compensation arrangement. And again, these plans can apply to current employees, former employees, in fact retirees, and can cover off business divestitures and acquisitions when you either have employees leaving or, of course, employees being brought into the fold. Let's compare an employee benefit trust to a health and welfare trust. When we consider health and welfare trusts, those trusts receive their direction under Income Tax Folio S2F1C1 Health and Welfare Trusts, an archived administrative position, long outdated of course, that is now being discontinued. And it really did serve under CRA's discretion. When it was first published on July 27, 2015, it did replace and cancel Interpretation Bulletin IT 85R2 Health and Welfare Trust for employees that goes back to 1986. Now, you need to be a resident in Canada to be able to participate or set up a plan like this and benefit from that. When we look at a history of the Employee Life and Health Trust, it was originally designed and implemented to allow major auto manufacturers to find a method for rearranging employee benefit obligations during the 2008 restructurings. You and your clients will recall that period as a massive market tumble resulting in a large drop in the value of equities. They're now for general use. The challenge we have with Employee Life and Health Trusts is that when you consider the original purpose, although they are for general use, the fit is poor and the conditions are overly restrictive when you try to apply them to many small businesses. The 2018 federal budget proposed to discontinue the folio we just talked about right now, S2F1C1 on Health and Welfare Trusts. The Canada Revenue Agency, in fact, will cease to apply its administrative position for Health and Welfare Trusts established after February 27, 2018, and for all such trusts after the end of 2020. So you can't set up a new one after February 27, 2018, and that administrative position will be removed even for existing trusts no matter how long they've been around after the end of 2020. And that's going to cause some concerns. There are some restrictions for Employee Life and Health Trusts. If the trust ceases to qualify as an Employee Life and Health Trust at any time during the taxation year, then it will be disqualified for the entire taxation year. And that's covered under subsection 144.12 of the Income Tax Act of Canada. And there will also be restrictions for key employees, covered again under subsection 144.11, subsection 248.1 of the Income Tax Act of Canada. Let's look at some of these restrictions. An Employee Life and Health Trust, we restrict the benefits provided only to key employees. Well, there will be limits on what you can apply only to key employees. And a key employee is defined as someone who is a specified employee definition or is covered under that condition under current section 240 of the Income Tax Act and holds significant shareholdings. So we're looking at a significant shareholder, or a high income employee where their income for 2 of the 5 preceding years is more than 5 times the yearly maximum pensionable earnings, or $236,000 when it was first set up in 2010. And in 2018, of course, that now means 5 times the yearly maximum pensionable earnings, $279,500. You can expect that to go up north of $280,000 in the coming years. In comparing an employee benefit trust, and again, a health and welfare trust now compared to employee life and health trust, let's spend a little bit of time on the differences and similarities between those two types of plans. Again, the health and welfare trust was covered under the archived administrative position, long outdated. CRA now has the discretion to apply the new plan. Of course, what they're really saying is you cannot establish a new plan after February 27 of 2018, but in their discretion, of course, they're going to be removing that folio, and even for existing plans after the end of 2020. And the health and welfare trust is typically designed for key employees, which may be extended to others in the same class. Contrast that to an employee life and health trust where there are restrictions regarding key employees, and it must be primarily designed for non-key employees and includes persons related to the employee or another employee life and health trust. And the legislation governing employee life and health trust was to take effect for trusts that were set up after 2009. So today, right now, we have 2 types of trusts in existence, coexisting to a certain degree. Health and welfare trusts cannot provide benefits for shareholders, partners of a partnership, independent contractors, even if these people paid for coverage themselves. And again, let's recall the history of an employee life and health trust. Originally designed and implemented to allow major auto manufacturers like General Motors Canada and Chrysler Canada to find a method for rearranging employee benefit obligations during the 2008 restructurings and when the massive tumbles in the markets occurred. And although, again, this is available on a general basis, just the makeup of the plan and recognizing that, most of the businesses that you're going to be interacting with are small businesses, there is going to be some severe restrictions that may prevent people from being able to even set up an employee life and health trust. With an employee life and health trust, you can have different classes of individuals with different types of benefits. Key employee benefit rights can be available, but they can only be the same. They can't be more as a class compared to a class where the class, including the key employees, must make up at least 25% of all beneficiaries under the trust. And the comparative class must be comprised of at least 75% of non-key employees. So typically what you're seeing is that the benefits available to key employees and non-key employees are going to be pretty much the same. At least two classes of those will be exactly the same. The effect of these restrictions is that an owner of a business must include 3 other employees with the same benefits to even be able to participate in an employee life and health trust. If there are 2 owners, then a total of 8 participants are needed. This is clearly not as flexible as the health and welfare trust. Again, comparing the 2 trusts, we look at the benefits that are allowed. An employee life and health trust can offer group sickness or accident benefits, a private health services plan, and group term life insurance benefits, the same as available under a health and welfare trust. In terms of the tax treatment to employees, it really is the same as if it's provided directly to the employees. And for health and welfare trust, again, the same. In terms of the tax treatment to the employer, and I'll go into this a little bit later on, the deductions are limited to the cost of the current year provisions. It's a little more vague, a little broader, a little more generous for a health and welfare trust, where the tax treatment of the employer is based on deductible contributions and what's left after those deductible contributions and deductible expenses. In terms of eligible expenses, for an employee life and health trust, it's available to current and past employees, but there are going to be restrictions on the number of key employees that can be part of this plan. With a health and welfare trust, you're looking at current employees. You can choose any class of employee, and typically these are set up for key employees only. In looking at the minimum number of participants, for an employee life and health trust, it's 2, but 4 are needed if a key employee is going to be included. And for health and welfare trust, you could see these plans set up for as few as 2 participants. In terms of benefits allowed, keep in mind that benefits include any combination of the benefits I just listed on that, as you can see on the chart. The income tax folio states that with the exception of a group term insurance policy, a health and welfare trust can provide health and welfare benefits under plans described through third-party insurance contracts, an insured plan, directly from the property of the health and welfare trust, or a combination of both. But group term life insurance cannot be self-funded. Now, there is no minimum number of employees that must be covered under a private health services plan. The new position on private health services plan, of course, has a Q&A section, a question and answer section, that goes to a detailed discussion of how these actually work. And you can find that under Technical Information Bulletin 339R2, under the meaning of a private health services plan. For employee life and health trusts, subsection 144.13 said there is no deduction for contributions unless they're related to designated employee benefits payable in the same year as the contribution. There can be no deduction for liabilities to make such benefits payable and for benefit payments made in future years. Non-deductible contributions are deductible in a future year to which they can be reasonably related. And that's covered under subsection 144.14 of the Income Tax Act of Canada. Employer or sponsor deductions may not exceed the contributions regardless of the extra benefits paid or payable or the investment earnings in the trust. The explanatory notes state that the new paragraph that was introduced, 18.1.0.3, specifies that contributions to an employee life and health trust are not deductible except to the extent specified in that new paragraph 21S. And that new paragraph in turn permits the deductibility of contributions to employee life and health trust to the extent that it's specified in the new subsections of the Income Tax Act. And of course, all references here are to the Income Tax Act of Canada. Let's look at the timing of these deductions. Contributions paid or payable to a health and welfare trust are generally deductible in the year in which the legal obligation to make the contributions arose to the extent that they are reasonable and laid out to earn income from business or property. These requirements were confirmed by the Federal Court of Appeal, Label versus the Queen in 2011, which concerned the deductibility of contributions made to health and welfare trust. Where the plans administered by a health and welfare trust are insured plans, the employer may only deduct in the year contributions equal to the premiums paid or payable by the trust to acquire insurance coverage for that year, plus reasonable administrative costs of the trust. Now, where the plans administered by the Health and Welfare Trust are self-insured plans, the employer may only deduct in the year contributions that were required to fund health and welfare benefits that could, again, reasonably be expected to be paid or become payable by the trust in that year, plus reasonable administrative costs of the trust. The Canada Revenue Agency will generally consider contributions made in the year that were actuarially determined to have been required to provide health and welfare benefits for that year. For an employee life and health trust, the employer or a contributor may deduct an amount in the current year equal to the sum of the 1, benefits paid out of the trust, plus 2, the life insurance premiums paid by the trust in that year, plus 3, prepaid life insurance coverage. And non-deductible contributions may be carried forward to a future year when benefits are paid. Let's look at how the trust is taxed on net income. Well, trust is taxed on net income on a calendar year basis, in other words, for the year ending December 31st. And the trust is treated as an inter vivos trust, so the trust will be taxed at the top marginal tax rate. When we can look at an employee life and health trust, the net income is the income after deducting amounts paid or payable to the employee beneficiaries, whether you're taxable or non-taxable. New subsection 144.16 has an exception to paragraph 21C dealing with interest not payable on borrowed money. Again, interest on promissory notes is not considered trust income, and payments on the promissory notes deemed to be contributions to the trust, of course, would be included. Administrative and claims expenses, including interest and promissory notes to the trust, are deductible as well, and insurance premiums are deductible. Deductions exceeding the income can be carried forward as unused amounts to a future year. Again, we look at the administrative and claims expenses, including interest on promissory notes. The taxable amounts are generally for non-designated employee benefits. Example, a distribution of surplus on the wind-up of the trust. Taxable amounts, of course, are going to be subject to withholding tax, but there is no special tax on designated income to a non-resident beneficiaries. So otherwise, there would be a 25% income tax subject to reductions by tax treaty. Let's flip over to a health and welfare trust. Again, the trust is taxed on net income after deducting the taxable amounts paid out of contributions made in a year where a legal obligation to make the payment is required to the extent that the contribution is reasonable. And again, of course, administrative and claims expenses for private health services plans are also deductible. Now, what do I mean by contributions made and insurance premiums made? Well, in terms, what I'm talking about here is that premiums and benefits are deductible. But benefits paid or payable out of insurance policy proceeds received by Health and Welfare Trust are not deductible under paragraph 1.46D. Insurance premiums are otherwise deductible, not the benefits, but the premiums, of course, and the unused deduction may be carried forward for 3 years. Let's consider the tax status of the benefits. The explanatory notes on employee life and health trusts include the following. Subparagraph 61A1 describes the benefits that are derived from an employer's contribution to various types of plans for employees. Again, that paragraph is amended consequential to the introduction of the Employee Life and Health Trust rules to add a reference to an employer's contribution to an Employee Life and Health Trust. Generally, therefore, benefits derived from such contributions are not taxable in the hands of the employees. Note that employee coverage under a group term life insurance policy is a taxable benefit because of subsection 6.4 of the Act. The introduction of an amended paragraph 6.1a will prevent payments of designated employee benefits by a tainted employee life and health trust that meets the definition of employee benefit plan from being taxable to employees. Exceptions, of course, are a private health services plan. Contributions made by a health and welfare trust to a private health services plan are specifically excluded from employment income by subparagraph 6.1a1 or I. The benefits received by an employee under a private health services plans are also not taxable. Private health services plan premiums, contributions, or other considerations paid for by the trust cannot be claimed by an employee under paragraph 118(2)(q) as eligible medical expenses. Again, if these benefits are taxable from the employer to the employee, then they're taxable to the beneficiary of the trust. Let's look at the wind-up of an employee benefits trust and perhaps the difference between a health and welfare trust and employee life and health trust. If there are excess funds on the wind-up of an employee benefits trust set up as a health and welfare trust, excess funds may not pass to beneficiaries, but they may be delivered to a charity. Contrast that to an employee life and health trust. If that type of a plan is wound up, excess funds may only pass to beneficiaries, another employee life and health trust, or to the Crown. So quite a difference there. Again, according to Income Tax Folio S2F1C1, the one dealing with health and welfare trusts, there is a paragraph in there that specifically states that a health and welfare trust is not subject to the 21-year deemed realization rule, as it is not considered a trust for purposes of subsection 104(4) of the Income Tax Act of Canada by reason of paragraph A1 of the definition of trust that's covered in subsection 108(1). That's a lot to say, so let me simply emphasize that a health and welfare trust is not subject to the 21-year deemed realization rule, as it is not considered a trust for purposes of the subsection of the Income Tax Act. So a very important to know for active trusts, and of course maybe an important consideration if that 21-year rule is cropping up around the same time as the end of health and welfare trusts at the end of 2020. One of the questions, of course, that comes up is that, well, how are we going to be able to transition from a health and welfare trust to an employee life and health trust? Again, there are no express rules for conversion as of the time that this presentation was taped in October of 2018. So now what? What happens? Trusts that don't convert to an employee life and health trust or are wound up by the end of 2020 will be taxed as ordinary trusts. The folio, which will be discontinued at the end of 2020, does state that it's possible for a trust to qualify as both a health and welfare trust and an employee life and health trust by making an election as to the operation of the trust. Again, no new health and welfare trusts are going to be able to be opened post-budget date. And I get questioned on this even today. No, you can't set up a new one. You can deal with an existing one, but only keep it active until the end of 2020, and you're going to be dealing with either wind-up rules or transition or transfer rules. Now, here are some key considerations for conversions. A conversion from a health and welfare trust to employee life and health trust. The trust needs to satisfy all of the requirements under Section 144(1) of the Income Tax Act of Canada. An existing health and welfare trust document may need to be amended to meet the requirements, and then elect to be treated as an employee life and health trust in its next annual income tax filing. Now, we all need confirmation of the transition rules. That includes financial advisors, legal counsel, accounting firms, trustees, plan sponsors, and all other interested parties. Top of the mind, of course, would be small business owners. The Canadian Bar Association is pushing for a 3-year transition period from the date that the final rules are published. Considering that some of these trusts were set up under collective bargaining, the transition period may need to be longer to account for collective bargaining cycles. The Health and Welfare Trust plan sponsor may not want to transition or do so without breaching paragraph 144(1)(3)(b), even though it's possible under paragraph 144(1)(2)(e) and F. So we have conflicting outcomes here when you compare one paragraph of the Income Tax Act with a second one. So think about the participation rules I covered earlier. It may not be possible to do that because of the number of key employees you have relative to the number of total employees you have. The rights and benefits for non-key employees may be just as advantageous as they are for key employees, perhaps defeating a prime objective of setting up the trust and possibly breaching a key employee's term of employment. After all, these old plans were set up to separate, to enhance, to provide an extra benefit to these key employees. And if you look at the participation rules and what has to be covered, the rights and benefits for non-key employees need to be just as advantageous as they are for those key employees. And again, you've defeated now a prime objective of the plan, and perhaps you've even breached a key employee's terms of employment. The benefit percentages may need to be the same under employee life and health trust. So would key employee lose benefits? Would key employee now have to be insured or under a different plan, or how would you deal with that? Would key employee benefits need to be provided separately? Well, in those cases, an extended transition period may be required to handle benefit payouts where it's still possible and wind down options. And so we're still waiting for clarification on how to deal with these harsh realities that exist for a number of health and welfare trusts. So we still are anticipating a fall 2018 draft dealing with health and welfare trusts. It still is the fall. We haven't seen the draft yet, but hopefully it's going to be coming up soon. And when it does, you can expect to hear something from me in writing. Let's look at convertibility considerations. Is conversion even possible? What is the makeup of the beneficiaries on the trust right now? And compare the requirements under health and welfare trust to the requirements under employee life and health trust. How many people are going to be covered? How many key employees are in that mix? What is going to be the cost of that conversion? Another convertibility consideration would be, what are going to be the legal and compliance implications of converting it, even though it technically may be possible? And then, of course, there are the tax considerations. How do we deal with surpluses? Are we going to wind it down? Or what about liabilities? What about unused deductions? What about the deductibility of contributions and payments? What if existing health and welfare trusts are deemed to be ineligible and can't get on side of the rules governing employee life and health trust? What happens? Well, stay tuned, and hopefully the government will come up with some rules that are palatable to all people that are concerned about these rules and are dealing with health and welfare trusts. I've mentioned before that we all have a Taxpayer Bill of Rights. According to the Government of Canada website, the Taxpayer Bill of Rights describes and defines 16 rights and builds upon the Canada Revenue Agency's corporate values of professionalism, respect, integrity, and cooperation. The Taxpayer Bill of Rights also sets out the Canada Revenue Agency commitment to small business to ensure their interactions with the Canada Revenue Agency are conducted as efficiently and effectively as possible. In addition to the 16 rights that applies to all taxpayers, the Taxpayer Bill of Rights also has a 5-part commitment to small business. The 5 commitments made to small business acknowledge their importance as the engine of growth in the Canadian economy. These commitments also complement the government's pledge to create a competitive, dynamic business environment in which Canadian businesses will thrive. They recognize the role of the Canada Revenue Agency and the role that agency can play in minimizing the compliance burden, specifically the amount of paperwork involved in complying with the tax system. But the federal proposals, the federal initiatives, these new federal regulations appear to be very much at odds with that Taxpayer Bill of Rights. Challenges, of course, bring opportunities. If shareholders can no longer sprinkle income, they may retain the income, potentially leading to a larger future capital gains tax burden. Explore the use of life insurance if the capital gains is to be triggered at death inside the corporation. Shareholders may withdraw future corporate surplus not needed for active business endeavors and invest those monies personally. Mathematically, it does make sense to optimize registered retirement savings plans and tax-free savings accounts to grow assets personally rather than grow them passively in the company. The exception, of course, would be when you consider a company setting up an individual pension plan, where, of course, the math may work very much in favor of an individual pension plan compared to a registered retirement savings plan for clients fitting the target market and profile. Other options, of course, include then individual pension plans, prescribed rate loans, and repaying shareholder loans. Make sure you sit down with your business clients and keep them up to date on what's happening with employee benefit trusts. Stay tuned for updates on this and watch for news on a new session covering running a small business and the rules entitled Corporate-Owned Life Insurance and Personal Estates.